Good evening, everyone. Jerry D'Ambrosio here, and it's my pleasure to present this week's special presentation, Improve Your Entries and Exits with these three technical indicators. Do you currently dedicate a portion of your portfolio to short-term trading to grow your portfolio faster? Would you like to have more winners than losers so you can get steady, consistent, reliable growth? Do you want to feel confident in your decision that you bought the right stock at the right time and that you will sell it at the right time? But the reality is, you never know when to buy a stock, you don't know what stock to buy, and you don't know when to sell the stock. So you're always second-guessing yourself. If that's you, if you fit into any one or all of those categories, I'm here to show you that you can use technical indicators to pinpoint when to buy, what to buy, and when to sell so you can reduce the time you spend trading every day, you can increase your accuracy, and also improve your results. So here's what we're going to cover tonight. We're going to talk about how to use top technical indicators. And what I mean by this is you'll understand what they are and how to use them to pinpoint your entries and exits. This will help increase your trading accuracy so you get more winning trades than losing trades. And then we're also going to talk about how to search for these trading candidates. You'll learn how to narrow down your list of candidates from thousands to just a few. This will help reduce the time you spend trading every day. But before we talk about stock selection techniques, we need to recognize what the market is doing first. So the market can behave in three ways. It can trend, it can behave in more of a trader's environment, and the market can also hit extreme levels, either extremely oversold levels or extremely overbought levels. Here's what a trending market looks like. We have the VectorVest composite here represented in candlesticks, and a trending market is the most comfortable environment to invest in. The market hits higher highs and higher lows, and you can see that here in 2017. So what we want to do is we want to buy stocks or add to existing positions at each subsequent higher low. After the market rallies, establishes a new high, then pulls back, eventually the market will stop going down, start to go back up again, and in an uptrending market, we are predominantly bullish. We tend to stay away from shorting stocks in an uptrending market because, as you can see, these retreats are very short-lived. Then the market can behave like this, right? Like it did in 2018. And this is more of a trader's environment. The market no longer hits higher highs. It no longer hits higher lows either. Sometimes it hits lower highs. Sometimes it hits higher lows. But it does trade more in a channel, bouncing back and forth between support and resistance. Now, for an investor, this is a nightmarish situation. It's ideal for a trader, though. And lastly, the market can hit extreme levels, like it did recently off of the December 24th bottom. VectorVest recognizes an extremely oversold market when the MTI is below 0.60 and the buy to sell ratio is below 0.20. Now that happened in December of last year, and we got a nice explosive rally on December 26th, and the market has really taken off from there. And I'll show you folks in a little bit how to recognize when exactly to take action off of these extremely oversold levels. So now that we understand that the market doesn't always just move higher, right? Hitting higher highs and higher lows, it can do other things like it did at the beginning of 2018. Now we have to talk about which indicators are ideal for each of those market situations. So for a trending market, the ideal indicator to use is the MACD. For a trader's environment, and we saw what that looks like on a chart, the ideal indicator to use is support and resistance. And then when the market hits an extremely oversold or overbought situation, the best indicator to use is the stochastics oscillator, and we'll talk about each one of these individually. Perhaps one of the most popular technical indicators is the MACD, or Moving Average Convergence Divergence. It's a great indicator to help pinpoint meaningful changes in a stock's price direction. It is a trend-based indicator because it's based on a 12 and a 26-day exponential moving average. Now, it's not important to get caught up in the calculation or the formula of the MACD. If you want to know the formula, you can just Google it. What is important is to discuss how to use it. So let's take a look at an example. Here we see a graph of APYX, and I've added MACD to the bottom of the chart. Now, the most common use is to look for times when the MACD histogram, that's these yellow bars here, cross above or below this zero line. This is a great indication that there is a change in the stock's trend. And you can see several examples here on this chart. And you can go through chart after chart and just ask yourself, did you have a chance to make money when the MACD histogram goes from below zero to above zero? So here with APYX, did we have a chance to make money? The crossover actually occurred on June 22nd, 2018. The stock stopped going down, began to go back up. The MACD histogram bars went from below zero to above zero. Did we have a chance to make money on this bullish crossover? Absolutely. July 24th, the stock stopped going up, began to come back down, and did this bearish crossover help us protect our gains? Absolutely. So a bearish indication or an indication to sell an existing position is when the MACD histogram bars go negative, go from above zero to below zero. And that was a great time to protect profits. The stock began to move down for quite some time, eventually stopped going down, began to come back up. Now this pivot point here was another higher low. So we're starting to see an uptrending environment, right? An uptrending stock. August 24th, 2018, we had a bullish crossover. Did we have a chance to make money here? Absolutely. Really nice gain here in about a month or so. Would this bearish crossover have helped us protect profits? Absolutely. You can't get much better than that. You're only a few days off of the actual high, which is in fact another new high. So here's your uptrending stock. Stock breaks down for quite some time. Look at that MACD histogram, how far and how long it stayed below zero. So we are out of that stock, looking for a better opportunity to get back in. And our next opportunity was November 1st of 2018. Stock stopped going down, established yet another higher low, and there was our bullish crossover. Now what you see here is the stock go off for about 6 or 7 days and then pull back sharply for about 4 days. Should we have exited this trade while that stock was pulling back? Well, if we're following the MACD, no, we shouldn't have, right? Because the MACD histogram never went into negative territory. So the indicator helped us remain in this position long enough to see some really substantial gains. Here was the bearish crossover, which of course would have been our opportunity to exit the position, move on to the next stock, or wait for a better opportunity to re-enter, and that was on January 2nd of this year, and you could see the stock continued to move higher. Now we just recently, on January 31st, got a bearish crossover, so that would have been your exit out of that trade. Now I know what you're thinking. You're thinking, well, I've used the MACD before, and it's never this simple. Well, let me show you another stock. Here's AVGO, and I've added MACD to the bottom of the chart. We can clearly see a difference in price behavior. This stock is a little bit more volatile and non-trending. But let's take a look at all the bullish and bearish MACD crossovers to see if we had any opportunity for some gains. So February 13, 2018, we had a bullish crossover. Bearish crossover happened here. That looks like it would have resulted in a loss, right? A losing trade. We sat out, which was good, right? Because the stock continued to fall. We had to cut our losses because the indicator told us to do so. About a month later, April 12, 2018, we got another bullish crossover. Bearish crossover happened on April 24th. That resulted in another losing trade as well. So you can just see that we're non-trending here. We're kind of moving sideways, not a very comfortable environment. May 8th, 2018, we got a bullish crossover. Now this would have worked out. This would have been a winning trade because the bearish crossover occurred on June 20th. The stock got crushed there for a few months, stopped going down, began to go back up. July 25th of 18, we had another bullish crossover. Now we got bounced out pretty quickly here because the MACD histogram bars went negative. Have to follow the indicator and follow the rules. A few days later, we were able to get back in. Now, this would have worked out. This would have been a winning trade. But so far, I think we've had more losing trades than winning trades. Now, we're really going to get bounced around quickly here. The end of last year, here's where our entry would have been. There's where our exit would have been. You could see the histogram bars went negative. Positive just a few days later. Negative a few days later. So you could see that would have resulted in a loss. So we're starting to see a few losing trades here in a row. So the whole point here is to, when using the MACD, favor stocks that are in nice steady uptrends. Think about it. The MACD is a trend indicator, right? It's based on moving averages. So it just would make sense to favor the indicator and to apply the indicator to stocks like APYX and not apply the indicator to stocks like AVGO. The stock on the right is not trending, so a trend indicator doesn't make much sense. Another very popular trading technique is to use support and resistance levels. One of the great things about the VectorVest tool is it has a way to automatically draw the support and resistance lines for you. Let's take a look at what I'm talking about. Before we get too deep, what is support and resistance? Well, basically a support level is a point where stock prices have stopped going down and began to go back up, typically on multiple occasions. It's where demand is deemed strong enough to support the stock from falling any further. Resistance is a point where stock prices have stopped going up and begin to come back down, again, typically multiple times. It's where supply is deemed strong enough to resist the price from rising any further. It's the ultimate crowd mentality indicator. Think about it. Have you ever bought a stock and watched it go up, but you didn't sell it because you thought it was going to continue to go up? And then what happens? It comes back down. Well, what do you say to yourself? Now you're at a loss, maybe you're break even. What do you say to yourself? Well, you say, well, if it ever gets back up there again, I'm going to sell it. Then once the stock gets back to that level, all the people who bought it back here the first time that didn't sell it, now sell it, which puts significant downward pressure on the stock's price, and it typically begins to fall. So how do you use support and resistance in your trading? Number one, let's talk about the buying opportunities. There are two buying opportunities when using support and resistance. If you see price hitting support and bouncing off of it, that's a bullish sign. Typically, price will continue to rise until at least the next resistance level. So when price bounces off support, that's a buying opportunity. The other buying opportunity is when price breaks through a resistance level, especially on high volume. Think about it. We already said that there was built-in selling pressure, right, around that resistance level based on the crowd mentality. Well, if a stock is able to overcome that selling pressure and bust through that resistance level, that's very bullish and would indicate a buying opportunity. Second, you can also use support and resistance to indicate when to sell an existing position or to initiate a short position. So if you see price hitting resistance and it begins to move back down, that's a bearish sign. Typically, it will continue to fall until the next support level. So if it's a stock that you own, if it's a trade that you're in, you should consider selling it or taking other defensive actions when you see price retracing from resistance. Now, let me be clear here. You're not going to necessarily use support and resistance to manage your core retirement holdings, right? This is more for shorter term trades. So I'm not saying that you're going to sell your Apples or your other retirement type stocks because they retrace from resistance. It's more for your shorter term type of a portfolio. If you don't own the stock, it would indicate a possible shorting opportunity if you are someone that likes to short stock. So price retracing from resistance is an indication to sell an existing position or to take on a short position. Additionally, and you don't really see this on the chart here, if you see price breaking down through support and moving lower, that is a bearish indication. Typically, it will continue to fall until it reaches the next support level. That's an indication to sell an existing long position or to initiate a short position. In a moment, I'll show you how you can automatically find stocks exhibiting these patterns. All right, so Two bullish situations, one price retracing from support, the other is if price breaks resistance. And two bearish situations, one if price breaks through support or if it retraces from resistance. The last indicator we'll look at is the stochastics oscillator. As with other oscillators, it helps pinpoint overbought and oversold conditions. Just like the MACD, don't let all the squiggly lines confuse you. It's not confusing. Let's take a closer look here at this example. On the lower end is the level of 20. That's the red horizontal line at the bottom of the stochastics chart. Would you agree that when the stochastics oscillator was below 20, that the stock was somewhere near a bottom or somewhere near a low? I'm not saying it was at the exact bottom, but it was at least somewhere near the bottom. Absolutely, right? We could see that time and time again with Abbott Labs. Now, a buying opportunity occurs when the stochastics oscillator moves from below 20 back above 20. You don't buy the stock just because the stochastics oscillator goes below 20. The stock can continue to fall. The actual trigger is when the stochastics goes from below 20 to above 20. So we can see here on May 22nd. Now, even though that doesn't seem like a very strong pullback or an oversold situation, it was enough to cause stochastics to go below 20. So if it goes from below 20 to above 20, we buy, and that was a really nice opportunity there. It happened here, too. Doesn't seem like a very strong pullback. It was strong enough, though, to cause the stochastics to go below 20. Crosses above 20, we buy. We had a nice opportunity for some gains there. How about here? August 15th of 17. Absolutely. The stock stopped falling, began to come back up. Now we're only about 2 or 3 days off of the actual low there, which is a really nice entry. Same thing here. The stock drifted higher, but we had another opportunity for some gains there. Same thing here. Now I'm just moving from left to right. Now we get into 2018, which we know was a little bit more difficult of a market to maneuver through. February 13th, 2018. The stock got crushed for a few weeks prior there. Stochastics went below 20, goes from below 20 to above 20, we buy. Now how about here? April 4th, 2018. So what is happening here? Well, the stock rallied, gave us a nice opportunity for some gains, but it stopped rising at the same level that it stopped rising here. So it looks like off of this pullback, it's establishing a resistance level. I'll talk about that resistance level in a moment. The stock fell. Stochastics went below 20. It crosses above 20. We buy. Now, the stock didn't really move much higher after we entered into it, right? It kind of drifted a little higher there for a few weeks and then began to come back down. So you can now combine what you've learned so far. Notice the level of support here now. So here's the pullback, right? We're in the trade. The stock doesn't reach the most recent swing high yet. It starts to pull back almost immediately. So now what are we thinking? We're thinking, well, when do I exit? When do I cut my loss if the stock continues to go down? Well, you now have an established level of support here. So what did we learn about support? Well, we learned that if the stock price breaks down through support, that's an indication to sell an existing position. So as price reaches or approaches that support level, we're thinking about exiting the trade. We don't exit the trade, though, because price does not break down through that support level. It retraces from it nicely, continues to move higher, and that support level allowed us to stay in this trade. Then what happens? Stock rises and approaches this resistance level. Well, what does it do? It pulls back, right? It retraces from resistance. What do we know to do if a stock that we're in, if a trade that we're in retraces from resistance? We know to exit that trade, and that would have been a good opportunity to take our gains off the table. It broke down for quite some time there. Stochastics went below 20. There's our next opportunity to buy on July 2nd of 2018. Now, what happens here? The stock rises and busts through that resistance level. What tends to happen is if price breaks resistance, it's likely to come back and test that zone. So once resistance is broken, that zone becomes support. Price breaks through resistance, it comes back to retest that support zone, retraces from it, and then comes back down to retest it again. So I'm just moving now from left to right. Here was another opportunity. So now what's happening? Not only is stochastics crossing from below 20 to above 20, it's also retracing from a support level as well. Now there are going to come a time or two where you find yourself in a losing trade. You follow the rules like you're supposed to. Stochastics goes from below 20 to above 20, you buy, and the stock doesn't move in your direction right away. Well, what happens? It breaks down, it moves lower than the most recent swing low. That's giving you an opportunity to exit that trade. You can always get back in, and you can see here was our opportunity to enter back in the trade. Stock rises. Where does it stop? The same level that it stopped previously, giving you a good exit out of that trade. Okay? Time and time again, you can see opportunity here for winning trades. Now here on December 27th of 18, here was our entry, right? Stochastics goes from below 20 to above 20. Stock only goes up for 2 days after that. What does it do? It falls sharply for the next couple of days. What do we have here? Now we have an established level of support again. You got 1 touch, 2 touches, 3 touches. So if we're in the trade and the stock is now approaching support, we know that if it breaks down through that support level, that's an opportunity to exit the position. It never did. It retraced from it, so that allowed you to stay in that trade. Next, you need to know how to search for trading candidates. You need to be able to narrow down your list of candidates from thousands to just a few and not spend hours upon hours doing it. There are a few ways to find your trading candidates. There's doing it one by one, which means you look at one graph, then another graph, and another. That's where you could be going through hundreds of charts in a day trying to find these patterns. Then there's using a search or a scan to help narrow down the field of candidates. So we're going to do each one here. I'm going to move us into the VectorVest software. Most of you trade stocks that you know, maybe stocks in the Dow or the S&P 500. So I'm going to go into Viewers, and I'm going to open up the S&P 500 watch list. And I'm going to graph the top 50 stocks that we see here. We're looking at the top 50. I'm going to graph them all. And I'm going to add MACD to the chart. So if I come up here, come to Add Parameter, go to Technical Analysis, select the MACD, scroll down to the bottom, and I'm going to apply the indicator to my chart. And I'm only going to look at the last 6 months. So what we're looking for today is, did the MACD histogram turn bullish today? So with CRM, give myself a date line here, did the MACD histogram first turn bullish today? The answer is no. It actually first turned bullish on February 1st, just a few days ago. So this would not be a candidate that we would look to trade today or Monday, because the MACD histogram bars did not turn bullish today. So we'd go to the next stock. How about here with FTNT? No, right? MACD histogram bars did not turn bullish today. Actually first turned bullish back here on January 7th. You could see nice support retracement on that day as well. So no, this would not be a stock that we would trade today. How about TDG? Nope. The MACD histogram bars did not turn positive today. Actually first turned positive on January 4th here, so we missed the boat on this trade. I'll go to the next one. Nope, MACD histogram bars did not first turn positive today. I can go through chart after chart. You can see how time consuming this will be. Okay, so Chipotle, no. Now it first turned bullish yesterday, okay, which would have been a good opportunity to enter into the trade. Look at when it first turned bullish here, back on January 3rd. Would this bearish crossover have helped us protect our gains? Absolutely. So I can go through chart after chart looking for stocks whose MACD just crossed bullish today, and it may take me a little while. It can be done, but it's a little time consuming. The other method is to use a search. So I'm going to go into the Unisearch tool here, and we have a tool within the VectorVest program called ProTrader. Now ProTrader is an add-on module. It's a one-time fee. We have included a link in the VectorVest views tonight so that you can take out a trial, a 30-day free trial to the ProTrader tool and try it out for yourself. Well, essentially what the ProTrader tool is, it's a scanning tool that will scan for technical crossovers. So if I open up the ProTrader tool and I go down to the MACD, crossover long. I can go ahead and run this scan as of right now. I'm going to add a one-line parameter though. We just looked at stocks in the S&P 500, right? So I want to add one line here that's going to filter by a watch list, and that watch list is going to equal the S&P 500. And watch this. If I run that search, let's see how many stocks it finds. Only 4. So we could have gone through 500 stocks one by one, and at the end of that process only find 4 stocks whose MACD just crossed into positive territory today. So obviously this is a much easier and faster way to go about looking for MACD crossovers. We also have searches in here looking for stocks. I'm just going to go ahead and say no there. I don't want to save that search. Retracing from support, or stochastics crossing above 20 as well. So let's do it. Let me walk you through a little case study here on the most recent situation that we've come out of, right? An extremely oversold market situation. So back on December 24th of last year, the MTI went below 0.6, the buy-to-sell ratio went below 0.2, and we had an explosive rally off of that December 24th bottom. On December 28th, a few things are going on here. The VVC had just confirmed a bullish reversal signal, a bullish candlestick reversal signal called a one white soldier. Now that happened on the 27th of December. The following day, the stochastics oscillator on the VVC crossed from below 20 to above 20. So let's say you reacted to that signal on December 28th, when stochastics crossed from below 20 to above 20. You had your explosive rally, you had a bullish reversal signal, you had confirmation of that reversal signal, and then the following day, you had the stochastics oscillator crossing above 20. So again, let's say you reacted to that signal on December 28th and you went and found stocks that had a stochastics crossover, crossing from below 20 to above 20. A good time to start thinking about taking profits would have been on January 14th when the VVC hit resistance. However, the VVC never retraced from that resistance zone. It stayed in that zone, hesitated in that zone for a couple of days, and then eventually broke through. Remember what tends to happen when price breaks resistance? It tends to come back down and retest that zone, which it did, and then retrace from it once again. That's why you don't simply exit when price reaches resistance. You wait for it to retrace from it, and it never did. So it would have been a good time to start thinking about taking gains on January 14th, but theoretically you could have entered into the market with stocks whose stochastics crossover just crossed above 20 and stayed in those stocks for this entire run. This is what it would have looked like had you run that search that night, the stochastics oscillator search on December 28th, 2018. Let's see what would have happened had you bought the top 10 stocks blindly, without looking at the charts. So to the close of yesterday, you had 9 winners and 1 loser. Basket of stocks is up about 14%, with the market up about 10%. So you're outperforming the market here by 40%. One of your biggest winners was MOH. Here was our entry, December 29th, the day after the stochastics oscillator went above 20. Well, we entered into the trade, and what happens? The stock falls for the next 2 days. It retraced from support, allowing us to stay in, eventually reached resistance, and then started to fall and drift a little lower. You had a lot of indecision here right at resistance. Dead money here. Best bet is to exit the trade. EWBC was another big winner. Here was our entry, stochastics first crossing above 20. Some more indecision right at resistance, but again, just because the stock reaches resistance doesn't mean that you run out and sell it yet. You wait for it to retrace from resistance, and it never did. Broke out above resistance, came back down. That resistance zone is now support. Came back down to retest that support zone and retraced from it. Well, folks, I hope you learned a little bit here about how to use technical indicators to improve your entries and exits. And don't forget, The link in the VectorVest views to try the Pro Trader tool out for 30 days is available. We hope you take advantage of that. Have a great evening and weekend, everybody. We'll see you again next week.